Like if you work with me, I will.
I'll be here.
So anyway, so I wanted to
My week.
Okay, folks, couple of reminders. I was looking at the master list. I know you all told me you picked a company already, but there still seem to be some missing company names. So around 5 o'clock today, I'm going to send an email out just to those people who've not put their names in. If you don't want that embarrassment, I would go fill in the name between 3 and, or just pick a company between now and 5 o'clock. Get it out of the way. Second is your first quiz is a week from today. Okay? Let me be very specific. First 30 minutes of class, 1:30 to 2, so don't be late on that day. It's open book, open notes, open displays. You can even open up your computer if that's where you have your slides. You can't start an Excel, partly because you don't need it. The numbers are simple enough that you can do them in your head, you can do them in a calculator. You can have a calculator on your phone, a calculator on your, I'm perfectly okay with that. But it's a 30-minute quiz and there will be class after the quiz, right? So any questions about the logistics of the quiz? So somebody remind me again, what do you have to do if you're going to miss the quiz? Remind me, let me know before the quiz that you're missing the quiz, right? So even it's 2 minutes before and you come up with a good excuse at least. I'm not going to ask you for a doctor's note. So if I have COVID, that always works. I mean, I can't force you to come in with COVID. No. So you can create COVID if you feel that's your good reason for missing the quiz. But my advice is take the quiz, because if you do badly, it's a one throwaway quiz. And if you do all three, it's good to get prepared for the quiz. Okay? You probably, if you didn't read my email yesterday, which I'm at this point, I'm assuming you're not reading my emails at all. I have extra office hours this week before from 9:15 to 10:15 and 12:15 to 1:15 Monday and Wednesday. Today's is already behind you. But I'll also have a 2-hour office hour on Sunday. Why it's so late? Because I have to wait till you review stuff before you can have office hours. So if you're working through past quizzes and there's something that's completely puzzling you, come to those office hours. So today we have a lot on our plate. Let's see where we were. We're talking about the cost of equity, risk-free rate, beta equity, risk premium. By now, you should at least have a sense of what each one does. The risk-free rate reflects the currency of your choice. The equity risk premium reflects the geographies you operate in. Your beta reflects the business mix that you have. But that gets the cost of equity. But equity is only one of two ways of raising capital. So in today's class, we're going to talk about the cost of debt, vastly misunderstood and ignored, much of analysis. Right? And then talk about the weights you need to go from cost of equity and cost of debt to the cost of capital. So let's talk a little bit about the cost of debt. I'm going to set up a very simplistic example. You have a company and you're trying to estimate the cost of debt for the company. You look at its books and they tell you they have $1 billion in debt that they've already taken. And they tell you at what interest rate. So you have $1 billion of debt on your books at it's called a book interest rate. That's the rate at which you borrowed at. Okay? But times have changed. The risk-free rate is now 5%. And given the risk in your company, the default risk, you should be charging a 2% default spread. So really the question is, when you compute the cost of debt for your company, should you go with the 4%? That's the actual cost of debt. Should you go with the 7%, which is this updated cost of debt? Should you split the difference and say, I'll take the average of the 4 and the 7%? Or maybe there's something else you would do. What do you think the right answer is for the cost of debt? You want to try, Leon? I'll tell you, most people use the book interest rate. I've seen cost of capital calculations using the book interest rate. And if you use the book interest rate, you are, in this case at least, being completely irrational. Why? Because your risk-free rate is 5%, right? Adil, what would you use? 7%. And you know how difficult this is as a sales pitch to CFOs, but I already have data in my books. It's only 4%. Why are you charging me 7%? Because this is an opportunity cost. When you think about investing in this company today, I can invest at 7% on debt of equivalent risk. Why would I accept a 4% rate? A cost of capital is not the cost of funding your company based on what you've already raised. It's a cost of funding your money today, given the opportunity cost. And why might book interest rates be much lower than market interest rates? Let's go through some of the reasons. Michael? Rates went up. That's so if you borrowed your money in 2020, I can almost guarantee you, and many companies have debt from 2020, that your debt is going to look cheap in terms of rates. What else? Joe, what else could cause which drives rates up? So indirect.
Your credit score could have worsened.
You could have become a much riskier company, right? Maybe you were AA rated then, now you're BB rated. And there's a third reason, which is in a normal shaped yield curve where short-term rates are much lower than long-term rates. If you take a lot of short-term debt, it can look like you have lower rates than the market interest rate. So today we're going to talk about the logic of why we treat all debt, no matter what maturity, as if it's long-term debt, and we attach an updated cost of debt to it, because that's the only way you can be consistent when you value companies. One more point, and this is, I think, I'm going to ask a more generic question. If you look at any corporate finance evaluation textbook, the weights you're supposed to use for your debt and equity are market value weights. It's almost like religion, right? So you're going through my corporate finance, this was it. And sometimes it's good to step back and ask why. Any of you working to a CFA in you or have a CFA already? Nobody? Okay. I don't have a CFA. I have no desire to have a CFA. I don't even want to have a whiff of a CFA, but for whatever reason, for the last 30 plus years, I've done the keynote to the CFAs. And I've kind of let the AIMR, which is the parent organization for the CFA, know what I think about what's happened to the CFA examination process. You know, it'd be, if somebody had been taking a CFA, I could have asked them about the torture. It's about 7,500 pages of reading that you got to go through. There are 3 levels, CFA 1, CFA 2, CFA 3. It's an endurance test. You read 7,500 pages. There's an exam, and you're asked, what was on page 4,335? And if you don't know, you fail the test. Why? Because in the CFA to have value, about 70% of people who take the exam have to be failed. So this is their way of deciding who passes and fails. And as I said, you have to fail a lot of people, but at least fail them for the right reasons, not because they know what was on page 4,335. So I've begged them to allow me to write the CFA exam. I don't think they're ever going to do it. But let's suppose for a brief moment, they gave me this window of you can write the CFA exam and give out certificates. So here's the question. Why in valuation and corporate finance do we use market value weights for debt and equity in computing cost of capital? I want you to start thinking about that question because I'm going to give you the choices, but start thinking about that question because if you can answer that question, I think you can come to kind of a core understanding of what a discounted cash flow valuation is. Don't give me the answer yet, but because I'll give you because I want you to think about it. It's not an easy answer. Right? The easy answers are going to lead you down pathways you don't want to go. But if you want to use market value weights, you need market value of equity. And for a publicly traded company, that should be relatively simple, right? Share price times number of shares and market value of debt, which can be a bit of a nightmare. Why? Because Even companies that issue bonds, like Disney, has a portion of the debt that's bank debt that's not marked to market. So what investment banks do when it comes to debt, they wave their hands, say there's no market value. And much of practice, you take market value of equity, you're following the rules, but you take book value of debt and use it as a proxy for market value debt. I can understand. But in this example, let's assume that $1 billion you saw was a bank loan. There was no market value for it. But what did I tell you about the loan? I told you the coupon rate on the loan, 4%. I gave you the maturity in the loan. And I told you what the current market interest rate was for that loan, 7%. Can you give me a sense of if you had to compute market value of the loan, of the debt, would it be less than $1 billion or more than $1 billion? Tell me why. It's like a bond with a coupon rate below the market interest rate, right? You trade at below par. We'll talk about the mechanics of doing it, but the market value of that $1 billion loan would be less than $1 billion. So when I compute my cost of capital, my market value of equity will be the billion, but my market value of debt will be less than $1 billion. So the debt ratio will actually be less than 50%, even though on the face of it, it looks like it's a 50-50. So again, mechanical issues that can kind of entangle you in the cost of capital. So let's go back to the notes where we left off on the cost of debt, and let's start building up to a cost of debt. And trust me, it's a much less intense process than bringing up the cost of equity. So here's the basic rule. When you compute the cost of debt for a company, it's the rate at which you can borrow money long-term today. Let me repeat that again. It's the rate at which you can borrow money long-term today. Two key words there, today, which means I don't care what you have in your books. I'm actually making your life a lot simpler because many companies might have 10, 15, 20 different types of debt on their balance sheets and don't even look at it. It's the rate at which you can borrow money today. And I don't care if some of your debt is long-term, medium-term, treat all of your debt as if it's long-term debt. And the pushback I get from CFOs is, but we have a lot of short-term debt. Why are you saddling us with this much higher cost of long-term debt? Why am I doing this? It seems like, I'm ignoring reality. For companies, a lot of short-term debt. Why am I not giving it the credit for lower rates on the short-term debt when I compute the cost of capital? Paola, do you have any ideas? I noticed you eating and I wanted to put you on the spot. That's okay, sorry.
Because you so today's rate, today's value is more of a possible opportunity.
But let me play devil's advocate. But I have my rate, now borrowed money short term at 3%, and the long-term rate is 5%. So I'm really paying only 3%. Why are you giving me a 5% rate in my cost of capital?
Because we don't know how long we can keep it at this.
Actually, we do, right? If the short-term rate is 3%, the long-term rate is 5%. What's the market telling you about what short-term rates will look like in the future? They'll go up, right? So if you think about borrowing money for the next 10 years, using short-term borrowing, you borrow at 3% for the next year, you borrow at the rate 1 year from now, your rolled over cost of short-term debt will be roughly your long-term debt. So I'm not contesting, you go use all the short-term debt you want, but I'm not going to give you a benefit of a lower cost of capital because you played the term structure. Right? So it's going to be long-term and it's going to be today. Which means you don't care about what's in the books. You have to come up with what that long-term cost of borrowing is today. And already you can see the pieces you need. You need a risk-free rate. Which risk-free rate? The same risk-free rate from which you built your cost of equity. If you see a cost of capital starting with two different risk-free rates, you already have an issue. So I use the 10-year T-bond rate as my starting point. And to that, I need to add a default spread. A default spread capturing that there's credit risk in companies and they borrow money. If it's a riskier company, I should charge a larger spread. Once in a while, you might think you've hit pay dirt. If you have a company that has bonds outstanding, the yield to maturity on that bond should already be that risk-free rate plus default spread, right? I almost never use a bond yield as a cost of debt. And there are two reasons. Anybody want to guess what the two reasons why it might be dangerous to use a bond yield as a cost of debt? Can a risky company issue a safe bond? Yeah, you can carve out your safest asset. So you can have a risky company which issues a safe bond. So if I take the bond yield from that bond and apply to all of the debt of the company, I'm going to understate the cost of debt. And if you add special features to the bond, God help you, right? You got convertible, then the interest rate completely loses any meaning. But if you have bonds outstanding, there's a bonus you get which you can still use to come up with your cost of debt. It's not required. But what do most companies, almost every company that has bonds outstanding also have available?
They're all called.
That,
It's like 80%.
yeah, but there's even more fundamental piece of information I get on a company that has bond that I can use to estimate a default spread, which is usually have a rating. Are you required to have a bond rating to issue bonds? No, you can actually issue bonds without a rating, but you're going to have a problem. People who are trying to buy your bonds say, why didn't you get yourself rated? He said, I chose not to. And what do I read into that? You must have some really bad reasons why you didn't go to a ratings agency. Therefore, I'm good. So almost every company that has a bond outstanding has ratings. And actually, if you look at ratings, ratings agencies rate both companies and bonds. So if you have bonds that are safe, you might give that bond a AA rating, but they'll also rate the company. And if you have the rating for the company, you're in a sense home free to the degree that you trust the ratings agency. Because if I know what your rating is, that rating goes with a default spread, and that default spread can be added to your risk-free rate. Now do you see why cost of debt is so much easier than cost of equity? Yesterday, I was looking at the bond ratings for every rated company from S&P. You can get from Capital IQ. Out of 48,000 companies, you know how many have a rating? By 2,500. So that's 2,500. Many of you would have picked one of those companies because they're more high-profile companies. I have a rating, and I can look up the default spread that goes with the rating. But there are 45,500 companies which have no ratings. So what do I do with those? Act like a ratings agency. Sounds like a messy process, but ratings agencies are the most transparent organizations in the world, not because they want to be, but because of what they reveal as public information, which is they tell you what the rating of every company they rated. It's public information. They also tell you what ratios they use. You can almost see ChatGPT saying, I can do this. And you know what? ChatGPT can rate companies, the most mechanical of all processes. 30 years ago, when I wanted to be a ratings agency, I didn't have ChatGPT to help me. What I did was I downloaded the rating for every rated company. I downloaded the 8 ratios that they claimed to use to get the rating. And I did some reverse engineering. You know what I mean by reverse engineering? I sorted the companies based on ratings, and I tried to guess which ratio is causing them to give companies different ratings and how much work is it doing. 30 years ago, that assessment, and still remains true today, if you have a non-financial service company, one ratio carries the bulk of the weight in explaining ratings. It's the interest coverage ratio. The interest coverage ratio is just operating income divided by the interest expense. So if you're a lender, do you want that number to be a high number or a low number? You want a high number. You want good protection. So the higher the interest coverage ratio, the safer you are as a company. And what I did as an add-on is I created a lookup table based on rated companies where if you tell me what your interest coverage ratio is, I'll go to that lookup table and I'll assess what rating you should have. I call this a synthetic rating to make it clear that this isn't coming from Moody's or S&P. This is coming from my taking Moody's and S&P's ratings and reverse engineering to come up with a rating for your company. Yes.
The predicted number, like you have like a standard.
Predicted number in what sense? They actually use current interest coverage ratios. The only predictive part comes about that they know your history, that your number, there's no predictive power in anything that ratings agencies do other than using historical data, right? So the company I'm going to use this for is Embraer, a company I've been visiting off and on for the last 50 pages. I took their operating income, and there, because the numbers were volatile year to year, I took the average operating income over time, divided by interest expense, and I came up with an interest coverage ratio of 3.56. I have to somehow convert that 3.56 into a rating. Right? So here's the lookup table, and you'll see the most recent version on my web page because I update it start of every year. You're saying, why are there two sets of numbers? Because the world isn't fair. If you're a large company, you can get a higher rating with a lower interest coverage ratio than a small company. Two sets of rules. So the first set of numbers are for large companies. So if your interest coverage ratio is greater than 8.5 and you're a large company, where large is defined purely in terms of market cap, greater than 5 billion, then your rating should be AAA. But to be a small company with a AAA rating, you need a much higher interest coverage ratio. I'm going to keep it simple because I'm not a fixed income guy. If I'm within shouting distance of the actual rating, I'm okay. So if you look at Embraer, interest coverage ratio of 3.56. In terms of market cap, it was a large company already. 3.56 translates into an A- rating. And in 2004, the default spread for an A- rated company was 1%. I'm pretty much done. I've got a default spread based on the synthetic rating. I can add it to the risk-free rate. There's one little tweak I have to worry about, which is Embraer is a Brazilian company. You're saying, so what? This is another unfair component of the process. For the longest time, ratings agencies, when they rated companies, had what was called a rating ceiling, which was no company in a country was allowed to have a rating higher than the country. It could be a really safe Venezuelan company, and guess what? Your rating could never exceed CCC. You're saying that's not fair? Hey, life isn't fair. Talked to a Greek company trying to borrow money in 2013. You walked into a bank and said, I'm a Greek company. The bank said 30% plus. So you haven't looked at my financials. You're a Greek company. So the final piece of the puzzle is if you're in an emerging market and you're doing the synthetic rating, if you're using an actual rating, you're going to be okay because when S&P rates Embraer, they factor in the fact that it's a Brazilian company. So the actual rating will already reflect country risk. But if you're using a synthetic ratings process, the country risk becomes a separate issue. So to get the cost of debt then, I start with the risk-free rate because I was doing everything in US dollars, T-bond rate. I add the default spread for the company, which for Embraer was 1%. But then I have to bring in at least some of the Brazilian default spread into the equation, saying you're a Brazilian company, so when people lend money to you, they will factor that in. If you want to be safe, add the entire country's default spread on. So you take the risk-free rate plus company default spread plus country default spread. Embraer gets so much of its revenues from outside Brazil in US dollars that at least in 2004, it was actually safer than the Brazilian government when it borrowed money in dollars. So basically what you see is a portion of the default spread. So you're saying why 2/3? You can use the variation of the lambda approach if you want to get that 2/3. Yeah? But as I said, if you feel uncomfortable estimating the 2/3, just add the entire country default spread. So risk-free rate plus default spread gives you cost of debt. If it's an emerging market company and you're doing a synthetic rating, you'll have two default spreads to bring in. And that gives me a cost of debt for the company, 9.29% in US dollar terms. Now, that table you saw, 2,500 plus companies, mostly US companies, used to be almost entirely US companies 20 years ago. And let's face it, the markets where I need the synthetic rating the most are markets like Indonesia and India and Brazil. And the question is, can I take this table built up using primarily US and some European companies and apply it to emerging markets? I can with a caveat. If your risk-free rate is roughly similar to mine, so if you're doing an Indian company where the Indian rupee risk-free rate is 5%, shouting distance of the US dollar risk-free rate, you know what, I'm going to take the default spreads from that table, add it on to the Indian risk-free rate and say that's the cost of debt for the company. But if you're doing a Turkish company, your risk-free rate is 21%. You might be a AAA rated company, but you're not borrowing at 21.5% or 21.7%. My guess is the default spreads will have to get bigger if your risk-free rates become much higher. We'll talk about what to do when you have really high risk-free rate currencies, because this is a mess that you saw with the equity risk premium as well. All our default spreads and risk premiums are dollar-based numbers. And you can use them on other currencies if the risk-free rates are close. But if they become very different, then you got to ask, what can I do to do things differently? And I'll give you a way out. But the cost of debt, you have to come up. You can never use the book interest rate. Now, don't fall back on that because it'll be a terrible estimate of the actual cost of debt. Yes, Adil?
That you added the spread for the country as well, right?
Yeah.
But in the ERP, you already calculated that.
But they're two separate numbers, a weighted average, right? So you're not double counting, right? You're multiplying by the weights. So if you have 60% one, if in fact, if I did not include in each one, then I'll be undercounting. So it affects both my cost of equity and the cost of debt. Adil's question was, when we do cost of equity, we bring in country risk through a country risk premium built on the default spread. When we do cost of debt, looks like we're doing the same thing, aren't we double counting? But remember, the cost of capital reflects weights. So you're not double counting, you're actually bringing it in through both components. Now, the default spread number that you saw in 2004 does change over time. Why does it change? For the same reasons equity risk premiums change over time, which is this battle between fear and greed, right? You get scared. What do? You push up the price of risk. You get greedy and you feel good, the number goes down. So this is actually default spreads in 2022. It's a year that was a tumultuous year for the equity risk premium. It started the year at about 4%, went up to about 5.7%, 5.9% by the end of the year. Why? Because inflation scared people. If inflation is scaring people in the equity market, why would you expect any different in the bond market? So in 2022, if you look at default spreads over the course of the year, every single rating class, you saw default spreads go up. AAA went up by only 0.14%, but if you look at C or lower, it went up by almost 5.57%. The lower the rating, the bigger the worry factor, the default spreads wide. Which means if you computed the cost of debt for your company at the start of 2022, and then at the end of 2022, you got a double whammy. One is your risk-free rate went from 1.51% to 3.88%, much higher base. And on top of that, you had a much higher default spread. My worry at the end of 2022 is the cost of debt had gone up so much. It was the biggest one-year change in the cost of debt for US companies in history, is whether they would be able to survive without defaulting. And when I wrote the piece on debt yesterday, where I looked through 2023 and 24, so far, fingers crossed, nothing bad has happened yet. But what's going to be the true test of these higher interest rates and whether companies can carry them? A recession, a global economic slowdown. And we came off a decade of 2%, 3% rates. We're now looking at 5%, 6% rates. And you've got to give the market credit. The companies have been resilient enough so far. But I think the true test will be, can they handle it through a recession? Because they haven't paid down debt. Because that was the other question, is will companies start to have less debt now that rates have gone up? They haven't paid, the amount of debt is still up there, like 10 trillion just in the US. And just to show you how much default spreads vary over time, in this graph, you have the default spread at the start of every year from 2021 to 2025. So when you go to my website and you look up the synthetic rating, the default spreads you will have are at the start of 2025. Can you use them in May? Fingers crossed, if there's no crisis, you're going to be okay through May. But if something terrible happens this month or next month, all bets are off. I'll give you a way of updating this default spread, because you don't want to stay with a stale spread if markets are kind of imploding and there's a crisis causing price of risk to go up. Any questions about synthetic rating, risk-free rates, cost of debt? Yes.
How do you do the cost of debt for a private company with no debt? They have overall-
First, where does the cost of debt go? It goes into a cost of capital, which is weighted by much. So if they have no debt, then it becomes a non-issue. If they have revolving debt, they have debt, right? The debt is on average through the course of the year. So the revolving debt might be you take it in March, you pay it off in November. It doesn't show up in your December balance sheet, but during the course of the year, you did use debt. So I would still bring that debt in. I'd attach a long-term cost of debt to it, even though it's revolving short-term debt. And I'd go through the same process of default spread and the risk-free rate, because there'll be interest expenses if you use debt. If you never use debt, it's irrelevant. I don't care what your cost of debt is, because your cost of capital will be the cost of equity. But if you do use debt, but it's seasonal, then I'll bring it in through that average number for the year. Now, I want to take a little tangent here. The cost of debt here is a market-based number, risk-free rate, default spreads. Once in a while, though, companies might have access to what I call subsidized debt. Subsidized debt is basically somebody lending money to a company at below market rates. Why would they do that? Why do governments sometimes do this?
You get a loan?
because they want to encourage people who might otherwise not have been able to start businesses. They have a social purpose. It might be an economic purpose, a part of the country that's under. It's in fact, I think part of the Tax Reform Act last year, year before, is if you built a factory in some part of the country where they felt that, or it could be a green energy company, you want to encourage. So governments do it. And of course, you had green bonds, right, with impact investing. The essence of a green bond is you're actually buying a bond and accepting a rate less than the market set rate. Why? Because you want to do good. You want to make the world a better place. But for whatever reason, sometimes companies can have access to debt that is subsidized. So I have a very pragmatic question. Let's assume that Embraer, where we computed the market set number to be 9.29% as a cost of debt, that the Brazilian government lends money to them at 6%. Why? Because Embraer used to be a government-owned company. It's a crown jewel for Brazilian industry, an aerospace company. They're lending money at a below market rate. You're trying to compute the cost of capital for the company. And you're trying to decide what cost of debt to use. And here are your choices. You can use the subsidized cost of debt, saying, I have access to lower rate debt. I'm going to reflect that in my cost of capital. You can reflect the fair cost of debt, 9.25%, saying this is a subsidy, I don't want to build it in. But in which case, what are you doing? You're missing that entire benefit you're getting from lower rate. Or maybe there is a way you can split the difference, because with each one of these, I think with each of the first two, there is a problem. With the 6% into your cost of capital, if you leave it permanently, you're assuming you get a subsidy forever. You might overvalue the company. With 9.29%, if you leave it in permanently, you're missing the subsidy value. Is there a way I can bring in the subsidy value into my valuation without bringing?
Using the cash flow?
Let's be more specific. What is that cash flow benefit I'm getting because I'm getting subsidized debt? Can we quantify it?
Through the tax savings on the interest rate.
First, let's get the interest payment. If I hadn't had the subsidized debt, I'd have paid 9.29%, right? So let's say I have $1 billion in debt. I'd have had 92,000 or $92.9 million in interest expenses. Because the government is giving me money at a subsidy, I'm paying only 60 million. I'm saving 32.9 million. For how long? For as long as the subsidized loan will last. That's it for the next 10 years. $32.9 million in savings. You can factor out the tax savings you'd have on that. But the present value of what you're saving because you get the cheaper debt will be a subsidy value for your company. That way, when you do your regular cost of capital, you can leave the cost of debt at 9.29%, value the company as if there's no subsidy, and bring in the subsidy separately. So what's the advantage of doing this? One is you don't make the subsidy permanent, right? Second, do governments ever give you stuff without expecting something in return? In my experience, that's never the case. So in return for the subsidy, the government is going to ask you to do something, which is going to cost you somewhere. So if you ask me, does the subsidy make sense? I can bring in the rest of the picture. I'm saying in return for this subsidy, here's what you're required to do as a company. You might have to sell your green energy at a below market rate. And this is how much you're losing. And net, you actually gain only this much, or you might actually lose from the government subsidy. You bring it in. So when you have a subsidy of any sort, whether it's a cost of debt or whether you have a higher price you're allowed to charge as a company, it's probably best to keep it out of your discounted cash flow valuation and bring it in as a separate piece. Because it'll allow you to control when the subsidy ends and how much value it adds. So the bottom line here is I would use the 9.29% cost of debt, my cost of capital. And then after I'm done with my valuation, I'll take that interest tax savings I got because of the subsidy, put a finite life on it, saying the government's going to give this to me for the next 10 years, take the present value of those savings and add that on to my value. And that way the subsidy value is part of the process. Yes, Adil.
What discount rate would you use to discount that subsidy?
That's a good question. So now that we're talking about the subsidy, what is the right discount rate? So lead me through how risky are these cash flows? No, it's a cost of debt. It's a debt cash flow, right? And how do we capture it's a cost of debt. So basically you take that savings, you discount back at the cost of debt. Why the cost of debt? Because it's a cash flow to debt. It's a predictable cash flow. and the present value will then be. So use that principle. Whenever you're saying, what discount rate should I use? Look at the risk of the cash flow and work backwards, because it'll always lead you to the right place. Yes? You had a question or no? Yeah, I thought you had your hand up. So let's go back to the weight question that I started at the start of the class. I said market value weights. I'll go through some of the reasons I've heard, because when I throw this out, I do that with CFAs. They already have the CFA, but I threaten to take it away from them. They give me the wrong answer. You know? So I'll go through some of the answers. I want you to play it through and say whether you're okay with this answer. Do we use market value rates because the market is usually right? What's the danger of choosing that as your reason? What do? We take this computer cost of capital with the market values, then we use the cost of capital to discount the cash flows, we come up with an intrinsic value, and then what do? We compare it to the market price, and you say, this stock is undervalued, this stock is overvalued, and you have me over a barrel. Because you can say, but you started the process telling me the market is usually right. How come you're now telling me the market is wrong? So that's not it. Is it because market values are easy to obtain? Relative to what? Book values? You look it up, shareholders' equity is just as easy. In fact, you could argue that book value of debt is easier to get than market value of debt. So that can't be it. It's because you take my view and my cynical view that accountants don't know what they're doing, and maybe book values mean absolutely nothing. And for some companies, I think that's true, but for most companies, that might be a bit of an overstatement. So what the heck is it? Because see, I'll tell you the internal inconsistency that if you're a quantitative person, that's going to create some pause here. We use market value weights, right? We come up with the cost of capital. We value the business, we subtract our debt, and we come up with an intrinsic value of equity, which is different from the market value of equity that we use to come up with the cost of capital. We have two values of equity co-inhabiting in the same discounted cash flow valuation. You say, how do you get away with that? There's actually an explanation for why we use market values of equity to compute cost of capital, and still can contend at the end of the process that the intrinsic value of equity is higher or lower than the market value. Every discounted cash flow valuation is actually an exercise in an acquisition valuation, where you're going out and buying the entire company. See, but that's not what I'm planning to do. I don't know what you're planning to do. The DCF acts on that premise that you're buying all of the equity in the company out there and all of the debt in the company out there in market value terms. Now, do you see why we use market value? It's a transactional value. To buy this company, you can't pay intrinsic value. You can try. You can't go around and say, I think the intrinsic value of NVIDIA is only $45. I'd like to pay $45. No, it's not going to get you anywhere. You got to pay the market value. We use market values of equity and debt, not because the market is right, because that's what we have to pay. So when you look at cost of capital, you're getting a transactional cost of funding the business. And of course, you're saying, what if my stock is not traded? What if I have a private business? There's no market value. I would still say you can't use book value. We'll talk about techniques we use to get around the problem, but we cannot use book value. Book value is meaningless in an acquisition valuation as weight for your cost of capital. No private business owner is going to sell you his or her business at book value. Right? So you have to come up with an estimate of market value. It's not as convenient because it's not out there, but it's always market value. So let's bring these all together for Embraer. As I said, we've been leading up to this page for 50 pages. Let's start with the cost of equity. First, I made a currency choice in 2004 to do the cost of capital entirely in US dollars. Why? Because I was desperate. There was no risk-free rate in reals, no government bond rate, so I'm going to do it in dollars. So my risk-free rate is the T-bond rate. For the cost of equity, I came up with the bottom-up beta for Embraer. So reflecting the fact that I don't trust a regression beta, I multiplied that bottom-up beta by a mature market premium. And then, remember, because Embraer's risk comes primarily from one country, Brazil, I used the lambda approach. Of course, if you want to use a weighted average equity risk premium instead of the lambda approach, it'll get you pretty close to the same number. My cost of equity in dollar terms is 10.7%. For the cost of debt, I started the same risk-free rate, but I had two default spreads. 1% is for the company based on the synthetic rating. 4% is for the country because it's a Brazilian company. I come up with a 9.29%. cost of equity, cost of debt. Cost of debt will almost always be lower than the cost of equity. Don't go to the next step and say, therefore, I should use all debt, because that's not going to follow. But that's even before taxes, right? Why? Because the lenders are always first in line. You're behind the lenders. If they're charging 9.29%, you should be charging a little bit more. For the weights, market value equity was easy. Share price times number of shares, $3,781 million. Or in REI terms, 11.04 billion REI. But when I tried to estimate the market value of debt, all I found was a book value of debt, 1,953 million. And if I follow the investment banking practice, that would become my market value. And to be quite honest, it won't make that much of a difference. I can get away with it. But I'm going to give you a neat little trick you can use to convert the book value of debt into market value. You saw this in my corporate finance class, but you're going to see it again. One way you can easily convert book debt to market debt is treat it like a coupon bond. The 1,953 million will become the face value of the debt. The interest expenses, 222 million from the income statement, will become the coupon every year. And the debt had an average maturity of 4 years. So think of a 4-year bond with 222 million in coupon every year for the next 4 years, 1,953 million the end of the 4th year. And since we know the cost of debt is 9.29%, you discount those, you're pricing a bond. And not surprisingly, the price you get for the bond is different from the book value. Why? Because their book interest rate, and this is the reverse of the problem that we started the class with, was actually higher than the market interest rate. So the market value of debt ended up being higher than the book value of debt. By so it's 2,083 million. That's what I used for my cost of capital calculation. Again, if you'd used the 1953 as your debt value and come up with the cost of capital, it wouldn't have been the end of the world. But the kinds of companies you have to worry are companies like Michael mentioned, where the rating has dropped, or the market value of debt can be very different, or interest rates have gone up a lot like they did in 2022. This is a good practice to have in your back pocket. When somebody says there is no market value of debt, therefore we can't estimate it, you can say, stop, we can estimate it, and here's a way of doing it. The end game here is, if you look at the weights, the equity is about 84% of capital. Debt is about 16%, and the cost of capital, the weighted average, is 9.97%. So this is where all of the numbers essentially come together. The risk-free rate, the beta, the risk premium. None of them is complicated. None of them is, rocket science. But you have so many moving pieces that if you're not careful, it's easy to be inconsistent in this process. Remember we talked about Turkish lira, the risk-free rate was 20%, saying, well, what do I do? All my risk premiums and default spreads are in dollars. One is you can stay with the local currencies. In 2004, the Brazilian real risk-free rate was 12%. I could have stayed with that as a risk-free rate built on top of it. But the cost of capital I'd end up with will reflect this inconsistency, high risk-free rate and risk premiums in dollars. So if you have a currency like the Turkish lira and you're doing a valuation in it, here's the safest way to do it. Do everything in US dollars for the cost of capital. Everything in US dollars. Even though you want to do everything in lira or reais, you do it in dollars. 9.97% was the dollar cost of capital for Embraer, right? But remember that neat little trick we used to convert risk-free rates in one currency to another? It's based on inflation. Let's say the inflation rate in reais is 8%, the inflation rate in dollars is 2%. If you're in a hurry, you can add the 6% to the 9.97, 15.97%. But if you want to do this right with the high inflation, you bring those numbers in, and my REI cost of capital will be 16.44%. Why? That extra inflation is on top. Notice there's no other adjustment to make. Country risk is already embedded in my dollar cost of capital. All of the things you worry about are in there. So that inconsistency between using local currency risk-free rates and dollar spreads is driving you crazy. And it does drive some people crazy. Do everything in US dollars. And at the last stage, do the inflation correction. Okay? One final point. In my cost of capital calculation, there are only two ways you could raise capital, right? Debt and equity. Once in a while, and I hope this doesn't happen to you, when you open up your company, you'll see debt and you'll see equity. And you see hybrids. What are hybrids? They're part debt and part equity. The most common hybrid is a convertible bond. Somebody explain to me how a convertible bond works. So what do I get when I buy a convertible bond?
That into equity portion.
But if first, let's start with the state. So do I get a coupon every year? Yeah. And there's a face value. So it looks like a regular bond, but I have an added feature. At any point in time, I have the choice. So it's an option you have to convert into shares. But why might you want to do that? What would cause you to want to convert a bond into shares? Yeah, if you have convertible bonds on Palantir, you're converting like crazy because you want to hold a bond and get a 3% coupon. You can convert to shares, which are worth 5 times what they originally were. So a convertible bond is a straight bond plus a conversion option. The convertible bond is debt. The conversion option is equity. Remember, you could have raised equity by issuing warrants, which is you skip the bond part entirely and raise equity through options. European companies actually use warrants fairly frequently. All you've done is combine them in one security. So if you have a convertible bond, my advice is break it up, and I'll show you a way of doing it, into the straight bond portion, put it into debt, and the conversion option portion, which goes into equity. Your problem goes away. There's another security that I absolutely hate. It's called preferred stock. And not the Latin American version of preferred stock, which is really common stock without voting rights. It's a US version of preferred stock. Here's how the US version of preferred stock works. You buy preferred stock, you get a fixed dividend. The dividend is set up front. It's not like common stock. And if the company is unable to pay the dividend, most preferred stock, the dividend gets accumulated and you get paid in future years. It looks a lot like a bond, right? And many people are tempted to take the preferred stock and include with debt, but there's one catch. What's the catch? Why isn't preferred stock, even though it is a fixed dividend and looks like a bond, why might you not want to include it in debt?
No tax benefit.
There is no tax benefit. So when you throw it in as debt and you multiply by 1 minus t, you're counting a tax benefit that doesn't exist. I have some really bad news. If you have preferred stock, you have no choice but to open a third source of capital. I try avoiding doing this unless I'm forced, but if you're a company which has 20, 25, 30% of your capital comes from preferred stock, you're going to have cost of equity times weight of equity, after-tax cost of debt times weight of debt, plus cost of preferred stock. You say, where do I get that? Very simply, it's a preferred dividend yield. There's no risk-free rate, beta, CAPM, none of that stuff is needed. It's whatever the preferred dividend is divided by the preferred stock price. If it's 8%, that's your cost of preferred stock multiplied by the weight of preferred stock. Preferred stock is actually a very inefficient way of raising capital, right? Because if you're a company and you borrow money, I give you a tax benefit. But if you issue preferred stock, you often are paying roughly the same cash outflow, right? Dividends or even more, and you don't get a tax benefit. So why do you think companies issue preferred stock? Any ideas? Yes.
Make it look like we have less tax, okay?
To make it look like they have less debt, so they're giving up the tax advantage to make it look like they have less debt. And you know where this makes a difference? In regulated companies, with the regulators have this very strange idea that something is called equity. It's equity in its name. It must be equity. Banks are the biggest issuers of preferred stock in the US because the regulatory capital ratios allow you to count preferred stock as part of your regulatory capital. So they're borrowing money, they're giving up a tax benefit, but they're looking safe on a tier 1 or a tier 2 or a tier 3 capital ratio. So often when you see the use of preferred stock, you're seeing some regulatory flaw playing out in how companies fund themselves. So before I leave this, I want to talk about how, if I gave you a convertible bond, you would separate it into straight debt and equity. Let's take a very simple example. Let's suppose you have a company that has a convertible bond with a face value of 125 million and a coupon rate of 4%. Let me pause right there. If there were no conversion option, you're going to get 5 million in coupons every year, 4% of 125 million. At the end of the 10th year, you're going to get 125 million. Let's say the market interest rate for this company based on its rating is 8%. If I asked you to price this bond, you could, right? Take the coupons, the face value, discount it all back at 8%. What you get as a present value is 91.45 million. See, what does that tell me? If this were a straight bond, you were buying it just as a bond, you'd pay 91 million. But convertible debt is traded. Let's say the market value of that convertible debt is 140 million. 91 of that 140 million is for the debt. What's the other 49 million for? Equity. So you don't have to value the options. And, basically, if you value one half, the other half kind of falls out. So if I'm valuing this company, my cost of capital, the 91 million is going to go in with the debt. The 49 million is going to go in with the equity. My hybrid has now disappeared, and I'm back to having just debt and equity in my capital structure. Again, all you're doing is drawing on bond pricing. It's amazing how bond pricing can help you out, kind of clean up these conversion options and how much are they worth. So that's it. We have the cost of capital, cost of equity coming from the risk-free rate, the beta, and the equity risk premium, the cost of debt reflecting the rate at which you can borrow money at. The tax benefit you get on the cost of debt is always at the margin. So we're already going to start a discussion of tax rates because interest saves you taxes on your last dollars of income. You apply the marginal tax rate to it. And the weights should be market value weights. And if you do have preferred stock, add in as the third component, just make sure the weights add up to 100%. Yes, Mike.
Yeah, back to the preferred shares. Would you view them differently, trying to compute the cost of capital if the preferred shares were cumulative or were not?
That's a good question. I think that it does create more of a cash flow burden, but it'll show up in the price. So when you do the preferred dividend yield, if they're cumulative, the preferred dividend yield will be lower than if they're non-cumulative. So it'll show up already in the cost of preferred stock. So I would just let it go through. So that's a discount rate. Took us a while to get there. Let's talk about cash flows. I'm going to lay out the big picture, and don't be intimidated by looking at all the terms because I'm going to just give you the big picture of what we're trying to do. Remember, there are two ways we can estimate free cash flow. One is to equity, one is to firm. If it's to equity, it has to be after debt payments. So you start with net income, you subtract out what you're reinvesting back in the business, and I'm going to divide what you're reinvesting into three components. One is what you're reinvesting into long-term assets, CapEx, but depreciation kind of offsets some of that. And what you're reinvesting into short-term assets, which is working capital, inventory, receivables. You start with net income, you subtract out reinvestment. And then you also subtract out other debt payments coming due. And if you're raising new debt, that's cash inflow. So when you're doing free cash flow to equity, you start with net income, you subtract reinvestment, you add cash from new debt, you subtract cash for debt you have to pay out, and what you're left with is free cash flow to equity. Lots of definitions we have to do is what goes into CapEx, depreciation. We'll come back to those, but in big picture terms, you're trying to estimate cash flows after debt payments. If you're looking at free cash flow of the firm, you can't start with net income anymore. Why? Because it's a pre-debt cash flow. Net income is after interest expenses. You climb the income statement to operating income, and then you act like you pay taxes on that operating income. Let me emphasize it again. You don't pay taxes on operating income, but you have to act like you pay taxes on operating income. That's why this is often called an unlevered cash flow. You're acting like you have no debt. You net the taxes out, and then you subtract out the same reinvestment you did in the free cash flow to equity, and you're done. Free cash flow of the firm. Free cash flow of the firm is a pre-debt cash flow. Free cash flow to equity is a post-debt cash flow. So when you look at the steps you need to get to both cash flows, first you need to get a sense of. So if I asked you, what is the free cash flow last year? You can't even answer the question until I tell you to the firm or to equity. But if I say, what was the free cash flow to equity last year? You start with the earnings for the company. You subtract out the reinvestment that they put in. And there are lots of tangles there of what you put into, what if they do acquisitions? What if they pay with stock with acquisitions? Questions we will have to confront. And then you subtract out debt cash flows if you're looking at free cash flows debt. So we're going to go through them and take each part separately, in terms of earnings and then what goes into CapEx and depreciation and working capital, but that's the sequence. I'm going to send you a link on a piece I did couple of years ago where I took Microsoft and just computed free cash flow to equity and free cash flow to the firm. I did it precisely because I got sick and tired of analysts talking about free cash flow and just stopping there. The free cash flow of the firm is, and they would make up whatever free cash flow definition they wanted. EBITDA is free cash flow. In what sense is EBITDA free? There's a lot of stuff that you have to do with the EBITDA. So one of the things we need is a little more precision when we talk about free cash flow. No. Now, as you work through the past quizzes on the free cash flow problems, I know some of you haven't looked at the quizzes. Don't worry, you still have a week to go when you have time. No, if you've still not looked at the quizzes on Sunday, we'll have a problem. No. You'll notice that there are multiple variants in how I get to free cash flow to the firm or free cash flow to equity. Free cash flow to the firm, there's a long way. You'd start with after-tax operating income and do what I just did, subtract out the difference in capex and depreciation and the change in working capital. Gives me free cash to the firm. I could consolidate everything inside the brackets and call it reinvestment. In fact, from the rest of this class, when you hear me talk about reinvestment, it is that consolidated number. I often get people pushing back when I do the reinvestment. Why aren't you counting in depreciation? It's in there already because my measure of reinvestment is capex minus depreciation plus change in working capital. Gets me to the same end, but just a different term, consolidating. The third way I can present the same thing is I take that dollar reinvestment, stated as a percentage of after-tax operating income. I end up with the same free cash flow, but I can give it to you as a rate. The advantage of telling you the percentage reinvested is it allows you to compare different companies. If you compare Microsoft to a small software company, if I told you the dollar reinvestment, how do you decide whether, which one's reinvesting more? By scaling it to after-tax operating income, and say, Microsoft invests 40% back as reinvestment, but Adobe invests 80% back. It allows you to make comparisons. So I don't want you to get confused because you see multiple equations. The end game is always free cash for the firm. How I get there can vary depending on what I'm using as my intermediate stop to come up with reinvestment. And you can do the same thing with free cash flow equity. The full definition is to take net income, subtract out reinvestment plus net debt. But again, if I consolidate that, I can call it equity reinvestment, which is reinvestment minus debt, or I can come up with a rate, that equity reinvestment as a percentage of net income. Again, for the moment, I know I'm throwing a lot of terms at you, but as we go further into the class, you're going to see me take these numbers and present them in consolidated forms. But I want you to understand that I'm still doing exactly what we've set up to do here, come up with pre-debt or post-debt cash flows. So that's my Microsoft calculation. In fact, I do this to kind of get a sense of what a company is doing. I start with the earnings number. That's a green number. And then for free cash flow equity, I step down by first looking at the reinvestment and then debt cash flows. So the gray is my free cash flow equity, lower than my net income, but it shows you where the money went. So it's a good way of tracking the number, because on a spreadsheet, it's kind of with the numbers, it's kind of difficult to see. But in this, I don't even know what this chart is called in Excel, waterfall chart or something. Basically, you start with the number and you scale down. You can see the numbers scale down as you reinvest, as you set money aside. Okay, so we're going to start on the cash flow process with accounting earnings. You already know where I come from when it comes to accounting earnings, but it is the starting point. You need the earnings. Without the earnings, we're kind of stuck. So there are three things I want to talk about in the context of earnings. The first is I'm only valuing the company today, not at the start of the year, not 2 years ago. So I want the most updated number I can for earnings. So if you remember, we talked about how to get the more updated number. You can't use the last 10K sometimes if it's from 2023. Right? So that's a pretty simple fix. Second, for your company last year, strange things might have happened to earnings. Strangely good things or strangely bad things. I don't want to be mysterious, but if you're an oil company and oil prices went to $120 last year, I can almost guarantee you that the earnings are going to look amazing. 2020, oil prices went to 32. There wasn't a single oil company in the world that reported profits for the year because at $32, other than Aramco. Who else can make money, right? So your earnings going up and down, we have to figure out a way how to normalize those numbers. That's a fancy way of saying, if I just use last year's numbers, God only knows where to lead. So we're going to update, we're going to normalize, and then we're going to clean up. Clean up after whom? The accountants. They've left a little bit of a mess because they're not always consistent about how they classify expenses. I'm going to talk about the three buckets accountants claim to use for expenses: operating, capital, and financing, and how they put the wrong items into these buckets, and it creates a mess for me when I'm valuing companies. So let's start with the updated part, and this is the easiest part, and it's getting easier and easier to do every year. In fact, if you use sources like Yahoo Finance or Capital IQ, they have a trailing 12-month number always at the end. But how do they get there? Very simply by adding up the last 4 quarters. But if you remember, there is a shortcut you can use. To get the trailing 12-month numbers, all you need is one 10K and your most recent 10Q. Let's say, Leon, that your most recent 10Q is from September. The first 3 quarters of 2024, you have the 2023 10K. Do you see how you can combine those two to create a trailing 12-month number? If you go to the last 10Q, it's going to report what you did in the quarter, but it's also going to report your revenues, earnings, all the numbers for the first 3 quarters of 2024, right? And it'll show a comparison to the first 3 quarters of 2023. It'll be right next. So here's what you're going to do. You're going to take the 2023 10K numbers. You're going to add the first 3 quarters of 2024 and subtract out the first 3 quarters. So it's basically 3 columns. In fact, it's a very simple exercise. Take the 10K, take the 10Q, create 3 columns. The last column, subtract out the 2023 first 3 quarters, add the first 3 quarters 2024. You got the trailing 12-month numbers. Why? Because you want the most updated numbers you can get. Some of you will start with that. By end of March, hopefully your 2024 10K would have come out if you have a calendar year end. And then you can replace with full 10K numbers. And for a brief moment of glory, you don't have to do any adjustments. You can just live off the 10K. And then the first quarter numbers will come out and the paint starts afresh, right? So don't think of it as something extra. It's just, it's something that has to be done when you value the company. There are some parts of the world where you don't get full quarterly reports still. Europe, for a long time, you'd get pieces every quarter, revenues, operating income, but increasingly around the world, both IFRS and GAAP are pushing towards full quarterly reports, and it gets easier then to create trailing 12-month numbers. Okay. But even with markets like the US, where you have disclosure on a quarterly basis, there'll be some items where you have to go back to the last 10K. I'll give you the example. One of the things we're going to talk about is stock-based compensation. And in the 10K, you're told how many options are outstanding, management options, when they come due, and what the average exercise price is. You need that to complete your value per share. But they don't report that in the 10Qs. So if you're valuing a Palantir, you might have the most updated trailing 12-month numbers for everything else, but on this one, you're kind of stuck with the last 10K. What do? Beggars can't be choosers. You take what you can get, move on. And your defense will be, this is the most updated number I could get for this particular input. So that's the first step, updating, because you want to value the company as of today. Now comes that messy part. Okay? I still remember my first accounting class, my professor came in with 3 cardboard boxes, very low tech, setup, and he labeled them. The first box he labeled operating expenses, the second he labeled capital expenses, and third he labeled financing expenses. And he said, in accounting, we're religious about the way we classify expenses. He was lying, but I didn't know then that he was lying. Because he said, if you have an expense that creates a benefit only in the current year, it goes into the operating expense box. If you have an expense that creates benefits over many years, it goes in the capital expense box. And if your expense associated with the use of debt, it goes into the financing expense box. So things like labor, material, operating expenses. Things like land, equipment, machinery, capital expenses, and interest expense. And if they stay true to that, then our life would be very simple in valuation. But there are at least 2 items that are routinely miscategorized. One no longer, but for a long time is miscategorized. A financing expense that was treated routinely as an operating expense. And I'm talking about leases. We'll talk about what makes for a financing expense, and you can very quickly see why leases should never have been treated as operating expenses. So the first fix is, if there are expenses like leases, then we've got to move them into the financing expense column. What that does is it moves an item that was above the operating income to below the operating, still an expense. Your net income might not be affected, but your operating income is. The second item is a capital expense that we know is a capital expense that is routinely be treated as an operating expense. And we talked about this in the start of the class quiz last time, things like R&D. We'll talk about the accounting rationale for why they do what they do. It doesn't make any sense, but we'll talk about it anyway. Because it screws up all of our numbers. It makes our income misstated, our capital investment, basically everything we need in valuation is misstated. So we're going to try to fix that. We're not going to wait for accountants to fix it. We're going to fix it now, because otherwise we'll be waiting a long time. So let's start with leases. Are leases an issue? Depends on the sector you're in, right? Retailer, restaurant, you're going to have a lot of lease expenses. That's the way you borrow money. But if you're a company like steel or auto and truck, there might not be much in leases that you have to worry about. So looking across companies, the amount of an issue leases is going to vary across sectors. But among those sectors where leases are a big issue, what accountants used to do with leases before 2019 was almost criminal. They took your biggest debt off the books, they made an operating expense, which made you almost, blind to the fact that this company was on the verge of bankruptcy. You had no idea how much debt it had. So let's start with why leases are a financing expense. When you look at an expense, what is the key question you have to answer to decide whether something is a financing expense or an operating expense? What is it about interest that makes it a financing expense? It's a contractual obligation, right? The minute I introduce the word contractual obligation, I don't care what you call it, it is effectively debt. Are leases a contractual obligation? I think so. You can argue maybe there's more flexibility in a lease. I'm not disagreeing with any of that. Having flexible debt is still debt. Leases have always been debt. Accountants have always known it's been debt. But because they got trapped in by a legacy choice made 100 years ago, it took them a long time to get around to that same conclusion. So when you look at leases, clearly leases are debt. So starting by 30 years ago, I decided that when I computed debt ratios for companies, I could not stay with the accounting definition of debt because they were missing a big chunk of what should make for debt. So I'm going to take you through the process of capitalizing leases. I know accountants do it for you right now, but I want you to see what's behind the numbers. So when you see lease debt at Walmart, how the heck do those accountants come up with a number? So here's the first step. If you decide leases are effectively debt, you've got to convert those lease commitments you've already entered into debt. Remember, when you sign that contract, you have commitments to make. And for the longest time, even before accountants came to their sense in treating leases right, those commitments have been in a footnote. Where you could see, this is my commitment for next year, 2 years out, 3 years out, 4 years out, 5 years out, and beyond year 5, you gave me a lump sum. All I'm going to do is take those commitments, discount them back to today at the pre-tax cost of debt. Why? Because these are commitments that I'm treating like debt payments. The right discount rate has to be the cost of debt. What I get as present value will be the debt value of leases. So I'm going to put it in the balance sheet as debt, and I have a problem. What's the problem? My balance sheet no longer balances, right? So what do? I have to create a counter asset. So when you look at Walmart's balance sheet now, you'll see a lease debt and you'll see a lease asset. And once I create a lease asset, the nightmares continue. What do I have to do in subsequent periods? I got to depreciate it. This is like give a mouse a cookie time, right? Basically, you invite him, give him a cookie, he wants milk, you give him milk, he has to take a bath, you take a bath, next thing he's taking over your house, right? When you decide to capitalize leases, you got to go the distance. So you got to restate the debt, you got to restate the assets, you got to restate the operating income. Everything is going to be different when you capitalize leases. Your income statement changes, your balance sheet changes. Now do you see why accountants were so reluctant to make this change? That's 80 years of CPAs down the drain, because you now have to think about a new way of showing this on your income statement balance sheet. So let's take an example. This was in pre-2019, which is when accounting came to its senses, in 2003. I was looking at the Gap. And this was when the Gap was actually a thriving retail store, which was opening new stores. Those days are done and gone are in the past. But in 2003, in their footnotes, this is what the Gap told me, that they had lease commitments of 899 million 1 year from now, 846. So basically, those are my commitments for the next 5 years. And in the 6th year, they gave me a lump sum of 1,976 million, which is spread out over 2 years. So I have the commitments for the, these are not expected lease payments. These are actual commitments you've entered into. You discount those commitments back at the pre-tax cost of debt of about 6%. What you get as a present value is about $4.4 billion. You're saying, what does that mean? Their lease commitments at the gap, if you bring them together, is effectively the equivalent of borrowing 4.4 billion. If you looked at the gap's balance sheet in 2003, their conventional debt was 1.97 billion. So if I trusted accountants, I'd have stopped there. But if you add in the 4.4 billion, the gap actually owed about 6.4 billion. The gap is a lot more levered than you thought it was when you capitalized leases. And that's always going to be the case. When you capitalize leases, your debt value will go up because you brought in this contractual commitment onto the books. And of course, once I do this, I can no longer use the operating income that they report, which was 1,012 million, because that operating income was after lease expenses being treated as an operating expense. So I do the right thing. I add back the lease expense, saying I shouldn't have subtracted it out. But there's one loose end to tie up. I now have a lease asset that's going to depreciate over time. I used a 7-year life and then do fancy things. I did straight line depreciation. My adjusted operating income is 1,362 million. So the gap has a lot more debt than I thought it did. It's a much more profitable company. So this is not just about whacking companies. I'm going to give it some good things, and I'm going to give it some bad things, and I'm going to ask you the question, what's the net effect going to be on value? The gap is more profitable than I thought it was. It's a lot more debt than I thought it did. In fact, if you're in a hurry and you want to do a shortcut, you can take the stated operating income, add back what I call the imputed interest expense, because this had truly been debt at a 6% rate. But do it only if you're in a hurry. When you have the full calculation is to add back the entire lease expense and subtract out the depreciation. So I actually did this at the Gap in 2003 because they were hearing talk that accountants would be capitalizing leases. They didn't understand that accountants, when they did the talk, would take 16 years to do it. So they were very interested. What will this mean for us as a company? And I have to tell you, as I went through each step, they went through stages of delirium before crashing and burning. So I started with the good news. I said, no, that's what accountants are doing. This is what the numbers will look like if I treat leases as debt. So I gave them the good news first. I said, you're a much more profitable company when I capitalize leases. My operating income goes from 1.012 billion to 1.362 billion. They were happy. Then I said, little bit of bad news. Right now on your balance sheet, you show only 1.97 billion in debt. It would look like you have more debt. And they were a little disappointed. And then I said, that's good news. Because when I compute your cost of capital, with the old definition of debt, your cost of capital is 7.31%, and now it's going to be 6.25%. At this stage, or the heights of delirium, higher earnings, lower cost of capital, life is good. And then I hit them at the final piece, and I said, there's one final catch here. The way we compute what you're making on your investment, the return on capital or return on equity, is based on book values. Right now, that book value of debt gives me a return on capital of 12.9%. But if I capitalize leases and I bring it onto the books, I have much more invested capital. Your return on capital will be only 9.3%. At this stage, they had no idea whether they were coming or going. They said, okay, we have higher earnings, a lower cost of capital, but our return on capital is also dropped. So what does this mean for our value as a company? And I gave them a suggestion on a shortcut they could use to see what effect the value would go. See the spread between the return on capital and the cost of capital? It's a very generic measure of how much more or how much you earn as an excess return. Before I capitalized leases, that number was 5.59%. They earned. After I capitalized leases, both numbers changed, but the spread has gone to about 3.05%. What does it tell me? The Gap is in a good business, but not as good as I thought it was. I did this for about 20 retail companies in 2004. For 7 of them, the spread actually went from positive to negative once you capitalize leases. That's when you cross that, you've essentially taken a company that you thought was in a good business and you realize it's a bad business. It changes the entire story for the company because every time they grow now, they're making you less valuable. So let's be very clear. We capitalize leases not because we're nitpicking, but because we want to get a sense of, am I in a good business? And there is zero chance you can answer that question at a retail or restaurant if you don't capitalize leases. So let's review. So basically, if you let the accountants do it, they will misstate the operating income the way they did it. So 2019, you subtract out the lease expense, your operating income is misstated, your book capital is misstated, your debt ratios are misstated, basically everything you do coming up. So the reason we're doing it is to get a much clearer sense of what is my company making its earnings, how much does it owe, what is its true cost of capital, and what is it earning over and above that cost of capital. Now, why are leases debt again? They're contractual commitments, right? How many of you are Netflix subscribers? I'm one. A lot of their content now is made within the company, but they still have content that they rent out. For the longest time, the Avengers movies were on Netflix. Disney Plus has reclaimed it. They had a 5-year contract. Seinfeld was on Netflix. Suits was on Netflix as well. These are shows made by somebody else. So how does Netflix get to show these shows on their service? What do? Michael? They have a 5-year contract, a 10-year contract. With Disney, it's a 5-year contract. That's why it took them 3 years to get it back, because there was time left in the contract. Right? They agreed to pay $80 million a year for the next 5 years. Is that a contractual commitment? Yeah. In fact, if you look at the Netflix footnotes, they have lease commitments, and right next to it, you see content commitments. When I value Netflix, those content commitments become the equivalent of debt, because they are contractual commitments. I bring them in. If you're that Saudi soccer team that signed Ronaldo, what does he get? $125 million a year for the next 4 years or something? They tried to sign Mbappe for $1 billion over the next 8 years. I don't think they succeeded. But are those contractual commitments? The Mets have a lot more debt today than they did a few months ago. Why? They've got this Soto bond outstanding, right? $765 million over the next 10 years. It's a contractual commitment. Again, I'm not saying it's good or bad, but when you look at sports franchises, the bulk of your debt might take the form of these long-term player contracts, and we have to treat them exactly the way we treat leases. I'm going to at least close off this process. Finally, in 2019, accounting came to its senses. In much of the world, IFRS and GAAP now require that all lease commitments be treated as debt. And of course, accountants being accountants, they can't just write a simple rule. They've got to write 100 rules with exceptions and shades. So, all these things you can do to escape it being treated as debt. But at least they've come around to the right sense of it's a contractual commitment. So today, for most of you, you're lucky. It should be already in. But I'll tell you something, I still don't trust accountants to get that lease debt right. One of the nice things is they still show me the footnotes with the contractual commitments, so I can check. So at end of every year for the last 5 years, I've taken the accounting numbers from Capital IQ for lease debt. I've computed the present value of lease commitments, which are also on Capital IQ, and I've compared the two numbers. So if you take Australia, New Zealand, Canada, the accounting estimate for lease debt is 8.4 billion. My estimate is 13.6 billion. In fact, across the board, my estimates of debt are higher than the accounting estimates of debt. And there's a very simple reason. Remember I said accountants have these sub rules and escape hatches? Basically, if you have flexible leases and you can get out of them, accountants give you an escape hatch. The only problem is, you think that makes sense, is companies read those rules, and guess what they then do on their lease contracts? They retroactively go in and... So in parts of the world, what's happening is companies have gamed the system to keep leases off the books. But before you dump on accountants, you know what analysts are doing? They're reversing what accountants are doing to go back to pre-2019 numbers. Even if accountants did the right thing, analysts don't seem to like it. They say, I'd like to go back to a pre-2019 world because I don't get this new stuff. So it's easy to blame the accountant, but there's a whole lot of blame to go around. Yes, Michael.
2019, was there like a boom in downgrades from the rating agencies?
No, see, the rating agencies already were doing it. In fact, you know how rating agencies treated leases? They multiplied the lease commitment by 8. And they treat it as debt. Why 8? Because in 1969, that was roughly the present value of a 12-year lease, and they've been too lazy to fix it. But ratings agencies have always, when they looked at Walmart, and this is the thing, accountants are the last people to come around to recognition that this is debt. Everybody else in the game has kind of caught it already. I'm going to at least start the R&D process. Now, I want you to think about it because I'm going to start the next class with it. R&D is obviously a CapEx. Accountants still treat it as operating expense. So the start of next class, I'm going to start with the question, why do accountants treat R&D as an operating expense? Because that's going to give us an opening as to how to fix this, because it is a problem. It's going to mean we can't value technology companies or pharmaceutical companies using the accounting statements because they're flawed by the treatment of R&D. So I will see you on Wednesday and we will talk about R&D.